JPMorgan is live on Ethereum. Franklin Templeton is tokenizing money market funds. Mastercard is building on-chain payment rails. The institutions that Web3 spent a decade trying to disrupt are now actually at the table, but they brought a gate list, and most Web3 startups are failing it. Not because their product is bad, because they don't exist in a way that institutions' legal teams can sign off. My guest today has sat on both sides of that gate. This is the Paybis No BS podcast. I'm Paul Ashar, and this is Michael Borowiec.
Michael, welcome to the No BS Paybis podcast. Great to have you on.
Thanks a lot.
Tell our audience the Michael story.
Well, the Michael story is 34 years old, so maybe we don't have time for a whole thing. But when it comes to Web3 specifically, I've been working in this industry for the majority of my career. So for nearly the last 10 years, and I really saw this industry kind of grow from this very kind of a budding, small GitHub and pizza innovation kind of startup thing into what it is today, which is a really robust technology that's standing at the precipice of basically institutional adoption. And it's been a really exciting journey, and I always like to stay close to the more institutional side of Web3, working for these startups. And I saw that a lot of them for the last couple of years really tried to get institutional adoption. I was working for DeFi companies who are trying to work with banks, hiring bankers and trying to make it work. I was working for decentralized AI startups who are trying to get traction with major Silicon Valley companies like OpenAI. And I saw that there was this really big kind of a friction between those two worlds where on one side you had the infrastructure partners like Web3 startups who really wanted to work, but they didn't even know how to speak to those companies, let alone do business with them. And on the other side, you have these big companies who were in theory interested in the technology, but there were just so many risks to do with it, regulation, just compliance, that they just basically just couldn't even touch it even if they wanted to. Right now, together with my co-founder Hassan, we're building Wiosna, which is a digital advisory company. And we're really passionate about really trying to bridge those worlds together. And the timing couldn't be better right now, especially being here at Money 2020. You really understand that there's so much demand from both the infrastructure partners and the bankers to work together. And for the first time ever, the regulation is finally here. So that green light has really opened those doors. But we still find that there's a lot of room to bridge those two worlds in terms of education, regulation, really hand-holding them through this process. And we're building this bridge together at Wiosna.
And typically, when a business comes to you and Hassan, why are they coming to you? What's the sort of the reason driving them to seek out this level of expertise and advisory?
That's a good question. We serve two types of giant industries on both sides of this supply and demand curve. On a supply side, you got massive infrastructure partners, also small fintechs who are building something for institutions. On another side, you have the massive commercial banks around the world, often in emerging economies, sometimes even Islamic banks with their own rules and regulations, who are interested in this. And we service them by helping to really, on one side, fast track the deal flow and connection to commercial partners for a lot of infrastructure players like stablecoin issuers, tokenization platform, custody players. On another side, for a lot of these bankers, we basically take care of everything from education to hand selecting the right kind of use cases for them. Like, let's say they want to explore cross-border payment flows or tokenization. We really look at their needs, their compliance stack, and select the right kind of partners for them to actually work with those guys. And we don't stop there. We really seal those deals for them. We oversee the entire project, and we draw the entire long-term roadmaps for them. But one thing I think that's most important that we've learned, and I think it's a very core of what we do, is that our main business is not digital assets. Our main business is trust, especially these big commercial partners that we're working with. They really need not only digital asset projects and to innovate the entire payment flow using stable coins. They need somebody to like explain this technology to them. A couple of weeks ago, we were doing like an interview of a journalist in one of these markets we operate with, because he took interest in the work that we're doing with local banks. And he was telling me that we need to write an article about the work that we're doing and explain to every man on the street what digital assets actually are. And I kind of laughed because I realized that, yes, the every man on the street needs to know, but even the regulators, the bankers, the CEO of these big organizations, they've got no idea about this technology. And this is always a step one of what we do at Viosna.
I want to pick up on that point because it's a really, really important one. The exercise I give to my colleagues sometimes is, look, there's lots of language, jargon, maybe buzzwords in our industry. And the task I give them is, how would you explain this to a moderately intelligent 14-year-old? And I'm going to ask you this question when it comes to sort of institutional gate, because this is one of the sort of core focuses of what you do. What is the institutional gate? And to use your example, how do you explain it to the CEO of a big bank who may not really get this?
Indeed. Yeah, that's also a really good question. I think we focus so much for the last 10 years on talking about how do you explain this to your mom or to your younger brother, but not on how do you explain to somebody like the CEO of Standard Chartered who can actually sign off on your project. I think by now we've worked very closely with, I think, over 100 infrastructural partners, and we're now consulting over 10 banks and emerging economies on this. So we've kind of gone through the process of learning exactly how to bind those two worlds together. And I think what is really important when discussing or explaining this stuff to them is to really understand how the technology looks from their perspective. I first had my insight into this when I was working for one of the DeFi projects a couple of years ago, and I was hired in a batch of people coming from Bank of America, Nomura Bank, Deutsche Bank to try to get institutional traction. So I already had this kind of an understanding what parts of the technology are important for them and how do they see it. And this is exactly what we're doing today when we're working with those banks. A lot of the times it's all about understanding how the actual business that they operate and work with, and what kind of analogies you can find for what they do in every day already and apply it to digital assets. So if you look, for example, at a bank, it's basically a massive internal ledger of assets and liabilities. That's a very easy analogy to describe to them how a blockchain is basically a distributed ledger, which encodes and enshrines a lot of these distributed mathematical aspects of making sure that it's secure, but allows you to operate and interplay with a lot of different banks, something that they spend a lot of money and a lot of hours doing very manually. So that's really good for them and really exciting.
Just on that point, because let's call it friction when it comes to sort of interbank transfers, cross-border payments, cross-border transfers, liquidity, all this sort of buzzwords, basically moving money. I want to put an argument to you, which is if banks wanted to remove that friction without kind of Web3 properties, there is a possibility that they could. It's sort of inbuilt into the system because, you make money on every sort of transfer or every kind of cross-border transfer. What is the incentive, therefore, from a kind of an institutional bank's perspective to start breaking down those walls and removing that friction with stablecoins and Web3 payments?
I think the more we talk to the banks and the more we understand their incentives, they divide between clear commercial incentives into also pure game theory and competition level incentives, and also governmental level incentives. And what I mean by that, let's start with the commercial aspect of things. Indeed, the banks are already doing a great job by operating a lot of these big international systems. However, the more I look at the actual like how the sausage is made, so to speak, it's extremely clunky. It can take multiple days if you're sending money in between different corridors, especially if you're sending massive volumes of money for B2B transfers. The money has to travel, or banks need to communicate with different regions on the way, for example, in between Asia and Africa, where they need to touch, for example, a correspondent bank in Frankfurt or in New York City. A lot of this technology is like very 80s and 70s. So not only it takes a couple of more days, even though it's pretty secure and reliable, but at the same time, there's a lot of cost for the bank itself. There's a lot of red tape for the bank that could be substituted. And also that cost trickles down to the customer itself. So not only the bank is paying more in order to have these relationships with correspondent banks like JPMorgan or Citibank, but at the same time, at the end of the day, they need to offshore that cost to the end customer. And that moves us to that second reason why there's a lot of incentive for banks to implement technology like tokenization, given the fact that if they're not going to do it and another bank has the green light to do it, if that bank moves fast on that, they can offer a much more financially less friction product to their customers. So, of course, if you are a Kenyan immigrant living in Dubai and you're sending money every day or like every week to your family back in Nairobi, you are always going to go for an option that is 5 times cheaper and takes a lot faster than the other option. So it allows you to capture more market, and of course the market adapts. But there's something else that we've learned in the last couple of months working with a lot of these big institutions. Because at the beginning, we're still very much digital asset focused. We're working primarily in the Web3 industry, but we spotted this opportunity with the green light for banks opening up across the world. My co-founder is coming from an investment background himself, so he was able to tap into a lot of his connections just at the beginning to just have conversations about what it actually looks like to have these kind of digital asset projects with them. And we were honestly extremely surprised to find so much demand where in a space of just a couple of months, now we're already scoping out pilots on stablecoins and tokenization, Islamic finance corridors as well. We're running, I think, 5+ training programs with a lot of these partners. And we're like, what's going on? These organizations are usually extremely slow to move on a lot of their stuff. They have thousands of people. In a lot of these countries, they're very traditional as well. So things move in a very bureaucratic way. But after talking to not only the bankers, but the regulators and the journalists in these countries, we realized that in a lot of them, they're now beginning to face actual pressure from their own governments to adopt this technology, given the fact that now the governments are realizing that technologies like stablecoins actually are not only good for the banks, they're good for the governments and economies themselves.
Yes.
To give you one example, a lot of these emerging economies especially are heavily dependent on inbound flows of money into their country. We already talked about the Kenyan example. This is happening all across the world if you look at how much money is coming from immigrants living in UK to their home countries. If you create a technology like stablecoins that can make it easier and cheaper for people to send money using official means, you vastly increase the money flow in the economy itself. So it makes perfect sense.
There's a great narrative arc often used in movies, which goes something like this. A senior kind of person in an old institution, sometimes in a nefarious criminal network, gets a kind of new, younger person to come in, teach them how to kind of do things better. And the narrative arc is that then they eventually sort of get rid of them because they've now learned. They've kind of institutionalized or onboarded that knowledge. Is that not going to be the case with big institutions? You know, when they learn the Web3 way, or they've kind of institutionalized some of the things that you've been saying about, why will they need ramp providers, stablecoin rail providers, consultants when they've done that. Is that a fair comparison, or do you think actually the demand is always going to be there?
I think it's totally a fair comparison, and I think also we see it happening to a certain degree. I mean, just let's give me an example of a company like JPMorgan, who for many years now have been experimenting with trying to create their own permission blockchain that services needs of their clients. Of course, now they have Connexus. So this is just one example of many, I'm sure, to come. I think Societe Generale also have their own blockchain called Forge, and there's a couple of other examples as well. So I think there's always going to be examples and use cases where these big giants who have so much budget and revenue and so many departments, so many people wanting to prove themselves, will want to experiment with this technology. However, at the same time, I would say that 80% of the market still will rely on external vendors. And these big banks, from our experience of working with them, not only have massive revenues and budget for external vendors, but in a lot of cases, they're old legacy institutions who are not very tech forward, and they'd rather just externalize and outsource a lot of these projects to companies that already have the use cases, already have multinational infrastructure that processes billions of dollars in one way, shape, or form. So I would say there's still a lot of space there. And I think not only there's still a lot of space for working with a lot of these institutional partners, but also for becoming the go-to player for a lot of these infrastructure projects. Like, now we're talking a lot with a lot of these bank partners about stablecoin flows, which obviously includes compliance and anti-money laundering policies, travel rule, all that kind of stuff. And we are explaining to them that when it comes to that stuff, the compliance is inbuilt in the transaction itself, in stablecoin flows and assets and custody managers. So, and without naming names, I think you probably know, and I know, who are some of the biggest on-chain AML players.
Yeah.
And actually, our account director made this point the other day. We were on a call talking to it back. There is still so much room for your infrastructure project to become this go-to, if you know, player for one specific part of the infrastructure stack.
Some of the problems that you were mentioning with, let's say, sort of legacy financial institutions or, some of the bigger players, are they more prevalent in emerging economies? You've made a strategic decision as a business to, if not focus on, certainly have a large part of your work and advisory going to institutions in those countries. So why emerging markets, and are there problems more acute there?
I would say the room for innovation and digital asset transformation is everywhere, because a lot of the global financial system is incredibly old and incredibly interconnected. So there's, like, the more you look at it, you almost see like there's almost this pyramid where a lot of the banks in emerging economies, of course, have their own presence in the market, but they're incredibly interconnected with banks in Europe, North America, and also increasingly in Shanghai and East Asia as well. So I would say that the same problems that, for example, Citibank in Frankfurt is facing, to a large degree, a large bank in Kenya or in South Asia is also facing as well. However, at the same time, working in Web3 generally, as probably you are also, if that's your experience, you see that there's a lot of exposure to working with people from all around the world. So working in a Web3 startup, in the last couple of years, you're very likely to be working on the same Slack huddle as somebody from New York City and somebody from Manila. So it really opens you up just generally to how a lot of these countries are a lot more open to trying new things because they have reason to be open to those things. If you live in London, you know how sophisticated and developed the financial system is there. They have less reason to explore and try new things, whereas a country or in South Asia or in East Africa has a lot room to grow for taking a chance on a tokenization product or a stablecoin product. So we see a lot of innovation there. I think I also touched upon already on how government is encouraging a lot of that. But also at the same time, we find a new breed of innovator on the infrastructure side in emerging technologies and emerging markets. We've worked a lot already in the last couple of years with Web3 native startups coming from places like Vietnam, Indonesia, Nigeria, doing amazing things. But now we see this new breed of entrepreneur in a lot of these places where we are working with this fantastic fintech from South Asia. These are people not coming from Web3. They're coming from established companies like Morgan Stanley, Blackstone, Amazon Pay, really, really experienced guys. And they are not interested in being a Web3 startup, but they're having a deep look at Web3 technology, in this case, stablecoin technology, and they're using that particular part of it to solve a really big problem in the global payment flows. And they've just done a fantastic job. We work with some infrastructure partners who have thousands of employees all around the world, but of this particular one, they have like 30 employees. But because they're doing something so specific, we've been able to make incredible gains with them. They're currently processing, I think, $500 million in USD volume this year. We're currently integrating them, one of the biggest institutional blockchains in the world. So there's a lot of hunger there, not only in the big banks, but also in these kind of a suit and tie fintech innovators as well.
Look, I'm a betting man. And if I had $10 million, let's say, and I said, look, Michael, of all of these emerging countries, who's leading the pack? Where would I sort of go to find the kind of the scale and the speed of innovation that you're talking about? You know, who would be your sort of top two countries that you've seen this level of innovation in?
Well, I would say that our most favorite market is definitely Pakistan.
Oh, wow.
Given the fact that we've got close ties to Pakistan, my co-founder, he's based in Dubai, but he's a Pakistani banker by origin, and now he's moved back to his home of Lahore to basically spearhead our operations there. We've also now onboarded a really brilliant account director from there who's coming from a governmental and USAID background. So we have a lot of development on the ground there. And not only talking to some of the major banks there, neobanks, Islamic banks, microbanks as well, fintechs, but also now to the regulators themselves and also Sharia scholars for finance. So I would say that because of our direct connections to that market, we've been able to make a lot of progress there, but also to see that there's a clear culture of entrepreneurship and indeed being open to trying new things, not only on a fintech level, but on a bank one and also regulatory. We also see a lot of interest in Latin American countries, some in East Africa, especially with countries that connect to bigger markets like Kenya, and also Southeast Asia. But Southeast Asia is probably not a surprise to anybody. They've always been extremely progressive when it comes to these things.
On the point of Islamic finance, just briefly explain to me the use case beyond, let's say, the typical use case when it comes to stablecoin rails, for example. What are they looking for and what needs to be different from a sort of more familiar or traditional financial institution?
Sure, yeah, I'm really glad you asked about this because it's been one of the most interesting parts of working for on Viosna in the last couple of months. For me, I've learned a lot about this subject, and now we're applying the lessons that we learned in Pakistan all over the Islamic world as well, the Gulf and things like that. So super, super interesting. I would say, of course, I am not like a Sharia scholar myself, but from my Western interpretation of what's really important here is that there are Islamic doctrines that pertain to how you do business, how you do investment, and how you hold assets. These revolve primarily on making sure that you're not charging interest, which is seen as like very exploitative. So, for example, a lot of like government bonds or mortgages go out the window. On another side, you need to make sure that the investments that you offer always have an actual real world utility underneath it. So a lot of cryptocurrencies, when it comes to their speculative nature, also go out the window. However, at the same time, we found that there's a lot of interest and also a lot of demand for Sharia scholars who specifically specialize in financial technology to basically dig into stablecoin flows, tokenization projects, and find exactly what we can experiment with. So for a lot of Islamic banks that we're working with right now, we are, of course, doing the same things that we're doing for commercial banks, which is like tokenization of deposits or stablecoin flows. But oftentimes they will have their own Sharia councils inside of the bank and top Sharia council in the country, which needs to make sure that everything that we do has that kind of a certificates. And it gets super, super specific. Like for stablecoin flows, for example, you need to make sure that the stablecoins that you're issuing has had some sort of a ruling from a respected scholar to make sure that the underlying assets underneath that stablecoin are not generating any yield. You need to make sure that even for a second in this journey where you're moving billions of dollars through different countries, the stablecoin is not converted to a cryptocurrency, which would make it again speculative in nature. You also have tokenization of sukuk, which is their own version of government bonds as well. There's a lot of really cool stuff, but at the end of the day, it's already about listening and learning. We've been lucky enough to work with one of the top Sharia scholars in Pakistan and also in the financial market. So we're really making sure to always refer to them when dealing with institutions.
It seems to me that the big prize for a lot of, let's call them sort of established Web3 players, is to get into the supply chains of the big boys, like the big institutions who are tokenizing, who are buying up stablecoin rails, etc. Is there still room there? And you're advising and working with a lot of these players. You know, what's the route in? What do they need to kind of offer these big institutional players?
Yeah, so to answer the first part of the question, the room is definitely still there. I truly believe, and I also see it firsthand, that the room for innovation and adoption is incredible, basically across every single market that we work with. A lot of these players don't even yet fully understand the technology itself, let alone have green-lighted massive projects where they allow even 1% or 2% of their annual flows to go for this technology. So for that reason, I would advise everybody to be very patient, because we're just at the beginning of a journey. But as to actually advising a lot of these infrastructure partners about what it takes to actually make a dent and to gain traction and eventually move to commercial agreements with these guys, of course, it's very case dependent on every individual market. I mean, even if we saw with the Islamic financial world, is so specific. However, if I had to take like a high level position, I think it goes down to patience, curiosity, and adaptability. By patience, I mean that you need to accept that if you want to do business with the big guys, it's going to take you a very long time and a lot of effort to actually gain their trust and to gain engagements with them. Realistically, you're looking at 12 months to 18 months to actually work with these guys. You have to assume that like 10 to 20% at best of your deal flow is going to convert into something. So you need to be very patient. And not only patient in like, oh, I just told my team on Slack to be patient, but your whole team needs to be built to withstand those brutal deal flows and actually see it on the other end. We saw it so many times working in Web3 where a company got a lot of money during a bull cycle. They hired all these impressive people, but couldn't really organize them very well. And within 6 months, the payroll just burned all the cash down. They had to fire everybody and basically start from square one. That's not going to cut it if you're going after the likes of HSBC or Standard Charters of the world. You need to be there, you need to be super adaptable, and you need to withstand and survive until you get at least one yes, which gets you that foot in. Then the second point is the curiosity element. You're going to have to accept that there's so much that you're going to have to learn about this industry that you're working with. You need every single touch point that you have for those 12 or 18 months, and you should have many of them, ideally like at least once a week. You just come into it from a perspective of not, I know how to help you guys, but how do you guys operate? What problems do you guys actually face? What kind of pressures are you facing as well at the same time? And you find that you're going to make a lot of mistakes, but also every single touch point is going to basically be a gold mine of potential information that you need to constantly adapt into your product. And they can get like really, really bizarre and very surprising. Like one time, for example, we were working with a fintech infrastructure partner. We managed to get attention of one of the biggest payment companies in the world. They are super excited, and we're being fast-tracked to basically develop a pilot with this company. And suddenly there was a sudden break in the relationship on a very surprising and very minute point, because everything was great, but we suddenly realized that they, due to their policy, are not going to sign any letter of engagement with a company that's headquartered in the Caribbean. And we're like, oh my God, like we would have never expected that to happen. So of course we regrouped, and they had also a Singapore entity, so we kind of adapted. And exactly, this is just one story of 1,000 times. You're going to have to be patient, learn, and just adapt in your product, in your documentation, compliance, everything you do, until eventually you just get to the point where you get at least one yes.
Let's say I'm a startup, a slightly more mature startup founder, and I want to become credible to the level of credibility that you just talked about with the large institutions. What is your brutally honest advice? What not to do? What is absolutely necessary?
So I think when we have these kind of conversations with our infrastructure partners, the way that I found explaining it to them that really finally resonates and clicks is to imagine themselves at the end of that journey. So let's say, for example, building on our previous answer, you've been grinding, you have like a tokenization project. You've been grinding for the last 12 months trying to get the CEO of Standard Chartered on a call to hear your pitch. You've gone through many routes, talked to juniors, gone to conferences, doors closed, other doors opened, and eventually through this process of adaptability and learning, you got yourself to a point where you finally have half an hour with the CEO of that company in a week's time. And you know that to get you to that level where this high-level executive is being actually blocked in their calendar, they need to treat you seriously enough to consider doing business with you. At the same time, you know that you're probably not going to get this opportunity anytime sooner. You only really have half an hour. You don't know if you have more. We've had calls with banks where they're interested in you and it's meant to be half an hour and you're there for 8 hours. That's a different story, and congrats if it happens to you. But you have to assume that you have less than 30 minutes in a very serious and a very busy executive's time to actually make your claim.
And what's going to grab that executive's attention?
Exactly. Like, you need to make sure that all of the things that I've mentioned so far in this podcast have been covered to a very minute level. You need to understand exactly how either business operates, what do they struggle with, where are the friction points where your product seamlessly integrates on a very technical level. You need to make sure that it doesn't only solve that problem, but it integrates it through their API. The whole journey of smooth integration has been taken care of, but it doesn't stop there. Your product needs to be stress tested and needs to make sure to give them the confidence that it's going to actually be able to process millions and sometimes billions in year one of these kind of payment flows or tokenization or deposits or so on. So that's just the product. This is just 20% of the pitch. After the product, which needs to be the best of the best, you need to present it like that, present proof of internal tests or maybe different use cases that you operated in. Then you have to start looking at things like regulation, compliance, into making sure you have the right licensing to work with them, making sure in a case of Islamic bank that the Sharia scholar has approved your thing. How is it going to work in a pilot? How are we going to scale it? What kind of commercials are you looking at, and how do they make sense versus how much we're going to make? How are you looking at it? That's also a very important point. how are you looking at the long-term view? A lot of these institutions are not looking for a one-time pilot or a 3-month project. They're looking for a partner that they can trust for years at a time. So you need to have a look at how you're going to scale this, but also how does that operate within the landscapes where they operate in. A really good example here is our work in Pakistan. So a lot of the partners that we're working there really love us because we're not only advising them on developing stablecoin corridors or tokenization for the next 6 or 12 months. We actually understand that in the next couple of years, their entire financial system is set to be converted to an Islamic one. So everything that we're developing them now, we're letting them know, hey, we took care of the Sharia compliance. So you're not going to wake up 2 years from now and say, but Vyosna sold us something that doesn't work anymore. And that kind of long-term and very detailed thinking just increases 100 times possibility of a CEO of a company saying, okay, you guys seem very professional, let's give this a try.
You mentioned the L word, licensing. MiCA has been a real huge leap forward for European markets and companies in those markets. If I was going to paint a challenging picture, I would say there are over 1,000 kind of crypto/Web3 providers across those 27 EU member states, and only just over 50 of them are currently MiCA licensed. Is that a good thing or a bad thing for you guys specifically? Does the pool get smaller, or actually is this a maturing of the market?
So I think that's quite conflicting to me because I was kind of professionally raised in the Web3 industry. And again, I understand there's kind of a pizza and GitHub mentality. And I think in a lot of those environments, this is some of the most important developments in the entire industry have been able to be created. I mean, if you look at the early days of Ethereum and the fact that we're just a couple of nerdy guys all around the world who were able to create this incredible protocol that now is basically servicing some of the biggest banks in the world. I mean, like JPMorgan together with Base are using it to process billions daily sometimes. So I think there's always going to be space for that. However, at the same time, I think that regulation and compliance has always been on the roadmap for the Web3 industry, for serious infrastructure providers. And I think the lack of that has actually created a lot of reputational damage that the industry had to struggle with for the last couple of years. So I think the real developer pizza and GitHub innovators are always going to find a way in order to create the really key innovations because they're just obsessed with them. They live at the top of their minds and they're not going to stop until they're realized upon the world. However, I think this kind of a licensing, whether it's MiCA, whether it's a Genius Act, Vara, or different combinations of those frameworks that are currently being developed in Asia, Africa, and other places, they're raising the bar of, I think, what an infrastructure project is. And I think if you're very serious about digital assets, blockchain technology being the future of finance, if you're serious about doing business with the likes of these massive correspondent banks or asset managements, investment companies, you need to accept that they are compliance first, and they are zero risk kind of companies. They would rather not do business with you if there's even a slight chance of getting a risk than to risk something for a potential gain. It's just not how they operate it. They have too much to lose. So I would say for the development and the growth of the industry, especially the infrastructure side, which I'm really passionate about, it's a must-have.
Final question from me. Where are you going to be in 5 years? What's the vision?
That's a really cool question and something that me and my partner Hassan talk about a lot. I think, to go back to my first answer, we really want to take the model that we're building right now, this bridge between the world of infrastructure and the traditional financial world. We want to, and are already taking the playbook that we developed in countries like Pakistan and Africa and Indonesia and basically expanding it in even more markets. I would say that in 5 years' time, we would like to have been responsible for a massive transition of infrastructure partners. The majority of the 100 that we have pre-vetted and we trust and know they're ready for institutional adoption. And we would love to be at the forefront of the story of transforming those very legacy systems that need the help of these infrastructures with the partners that we trust.
Noble ambition. Michael, thank you very much.
Thanks a lot.